Let me little explain about this particular program. So as I have told you all, so this is a 4 days program. So it is a 4 days program, and small modification also I did in the topics of this event. One small modification I made in this. So it's a 4 days program. Today and tomorrow you have, and then it is followed with the 22nd and 23rd. So this will be a repeated session. So 22nd and 23rd, I'll be taking the session in Hindi. So whatever I'll be discussing on 20 and 21st, the same thing I'll be repeating in the 22nd and 23rd in Hindi. So this is what we are going to uh, have in the session, and what are the topics. So that is very important for you, and it is a free session. All of you have got that link to register. You can invite your friends to register for this thing also. One small change I brought into this. So one more topic I have added for the investors. So why to invest in the equity mutual funds at this point of time. So there are specific technicality behind it, so that I will be just discussing something in this. And then our trading part of our education, the topics remain same. So here, how you can do intraday and positional trade in the options. What is the process? What is the process to do intraday trade in equity, future, commodity using the Fibonacci and volatility? Most of the times I have taken this, but one small alteration, small change is there. So based on this current high volatility scenario, one small change is there. So that also I am discussing. And you will learn how to do the pair trade in the Nifty and Bank Nifty. It is one of the best technique, so that you can able to learn. Dynamic Gann square of 9 principle, how you can do intraday and positional trade, and the best option strategy which will be suitable for this result season. Because today you will be seeing that Infosys is going to give the result, and the days to come many companies will flag their result. So that part also will be there, and how you can utilize Elliott wave in this current high volatility situation to make the investment decision. So these are the things you are going to learn in this program. So to start with, I'll be going with the first part, why equity mutual funds now. So what is the process of investing in the mutual fund? So many of you will be having some or other investment in the mutual fund. But what normally the investor used to do, so when you heard some of the mutual fund investment concepts, so people say that invest for long term. So there is no long term which can give you a windfall return. So many funds, you can see that there is some 3,600 funds is to available in Indian market. Out of that, only 300 to 400 funds used to perform. Remaining funds never used to perform also. So that is one part. Second part is just investing in the long term. It doesn't solve the purpose of one investor. So as an investor, you must find out the opportunity in any fund. You must need to see the basket of stocks what they are having. So first thing is that you need to know what is the opportunity in that fund. Second, that basket of stocks is very, very important. So whenever there is a market fall happens, so all sectoral indices, every stocks, everything used to fall. And when there is a recovery, the large cap stocks used to give the steepest recovery. The first recovery comes from the large cap segment, followed with the mid cap and small cap segment. So this is the process of a mutual fund investment, and you need to do some active switchings. What is the active switching? So normally, if you put directly into the mutual fund, you are exposed to the highest risk. So always I used to advise the people, park your money in the liquid fund, which is a debt kind of instrument where you have a small yield will be there, and slowly you move. So 2%, 3%, 5% based on the market condition, not give a random systematic uh, switching. So systematic switching means every month one amount will be get switched, not like that. So whenever there is a watch for the corrections, when there is a correction, have a part of fund you can move to your equity funds. So this is the process. If you follow, then there will be a good amount of gain you can get. So if you would have heard that long back, so 1 year back, I have taken one small webinar where I have told you how you can put the investment in the ETF, exchange traded funds. So I have told you that, so 2 to 3 things you need to look into. First one, valuation, earning, market outlook. These 3 things, the fundamental part you can look into. So the trading lessons I will be following with. So whenever I have just taken one sample of all these things. Valuations, whenever you compare, you must compare the large cap stocks, the stocks which is having a higher weightage in the index. I have just taken some index stocks, Nifty index stocks. So when a great amount of 10 to 12% minimum, 10 to 12% average correction happens in the large cap stocks, so that is a good time that you must start deploying your capital to the equity mutual funds. So here just I have just taken a small example here. So I have just given you that these are the stocks, these are index stocks, Nifty index stocks. If you compare between their 52-week high and low and percentage wise corrections, you can find out that there is a great amount of corrections has happened. So this is the first thing, is that this is how you should check the valuations. So when you are going for checking the valuations, that should be average 10 to 15% of corrections should happen in the index basket. So that is the best time you should start deploying your money, but not at one stretch. That is very, very important, not at one stretch. Second parameter you have to study is price to earning ratio. Many of you will be knowing that price to earning, how to know about this price to earning ratio. So you have the current price to earning. So that is per share, what is the earning potentiality is there, that is called your price to earning. Price of the share, so divided by, so that is per unit share, how much the valuation is there. So that depends upon that growth rate and other things. So you just have Google little bit, you can able to find out what is the price, how to analyze a stock based on its price earning ratio. So these are the parts are very, very important to check your valuations part. So now coming to the next other parts of our market outlook, when in fundamental point of view, not in any technical point of view. So if there is a crisis like COVID-19 now, so maybe some other crisis may surface in some future time. So when there is a crisis, there is an opportunity. It is a common term in the stock market. You can see that when such kind of crisis happen, what are the actions legislatively it has been taken? What are the actions business wise it is being taken? So you have seen that to bring the competitiveness, few months back there is a cut in the corporate tax rate, so which is going to add into the profitability of the many corporate. So in return it is also going to increase your employability, everything. So many other, so current scenario you will say that RBI said that there should not be, banks should not announce any dividend. How does it impact? So recently you would have seen few days back, how does it impact? If banks doesn't give any dividend, how does it impact? How you can understand this part? When banks doesn't give any dividend to their majority or minority shareholder, that means that accumulation will be there. So that money should be with them. So that money will be adding to their balance sheet. So that balance sheet will become a fat balance sheet. Then second part, what are the actions? There is a crisis like COVID-19. You have seen that, yes, many parts of the people are shouting for different stories. So we have a great population, we are not testing enough, we are having many odds. So all talks about the odds. So now question is, the actions what are being taken now, whether it is having going to have any long term impact. Definitely you can see that there is an announcement that a dividend will not be distributed. There is a announcement that your FDI requires some government approvals, so your industries core should not be set. There is an announcement that your agriculture sector will be getting a good flow. So here India is a very typical country. You would have known that every time we migrate or any policy announcement happens, the marginal section of the society contributes to the higher growth of the country. Marginal section so of the society, you can say that. For simple example, any telecom provider you take, you can take Jio, Airtel or anyone. Those telecom providers are having more number of clients, prepaid clients, as compared to the postpaid clients. So they contribute 50 rupees recharge, 100 rupees recharge, 1000 rupees recharge. However, they maintain multiple connections. So here question is, the marginal section of the society contributes more towards that. If you say that 80% of customer base belongs to the prepaid category, and any small move to their hand will have an immediate impact on the economy. So these are the facts, says that on the day forward, post this COVID-19 migration, the marginal section of the society is going to contribute a greater part of to the economy. Now, this, if I can just see that whatever the current valuations of the market or current uh, steps taken by the government, and whatever the COVID-19 related damage is there, it's a consumption story is more. Here, India is a country of 130 crore people. Here, majority of the people, if you say simple way, you can see, if you produce more grains and you don't have people to eat those grains, what will happen? That will go for a, it will rot in the store, or you need to export it back. If somebody doesn't give a cost, then your your production gone waste. But it is not a country like us, is not like that. We are a major population, so anything we produce we have the capacity to consume. So that is one part of our great nation. So here, for that reason only, I have told you that why current situation is best for a investor to deploy a part of their money into the equity mutual fund. Valuations, earning, and market outlook going forward. These three parameters suggest that it's a good time to deploy that money into the equity mutual fund. But it must not be at a stretch. Phase by phase, you should have a 60-40 ratio. You must have a, you can say 40 to 50% of your money should be in the debt instrument. Another 50 to 60% should be in the equity segment. As I have told you, once the markets start recovering, the large cap segments will recover fast, and it is the great time you can deploy some amount of money into the large cap and large cap segment, and that will be the good for the investment now. So this is one of the topic which is not scheduled for this program, but I thought that I have to add this topic, and it is a great thing you can able to take benefit of that. And also we have many in smart finance website you people are visiting, so it too also have a mutual fund segment where it online you can able to invest. We are also involved in this mutual fund asset management business for a long period of time. From the year 2005 onwards, we are into this mutual fund asset management business. So if you require our help to deploy and to know which are the funds I should deploy. So we have a dedicated desk. So you can call up this number belongs to me, and to have one more a financial analyst with us. So you can contact any of these things, and through our web portal also you can invest. So that is a transparent process. Nowadays most of the things moves online. Everything will be maintained in your name, your record, everything. But you can able to do investment in this, and few fund houses we have given in our website, but all fund houses we can able to give you that online facility, app, everything. Fine. So now, or you can invest with your own existing mutual fund accounts, whichever is your process, you can do it. But the very idea of telling you this is the best time you must invest a part of your money into the equity mutual fund. Now coming to the trading part. So here I have scheduled this topic, intraday trade using the Fibonacci and volatility. As I have told to you, this concept of Fibonacci and volatility is being taken many times, but now it is a critical case. A case wherein this same method requires some realignment, some rework on that. So I will just demonstrate in that part. So here, once you are once you are going to trade using this intraday trade using the volatility and Fibonacci principle, what are the processes you need to follow? First you need to derive the daily volatility from the past 10 days data. If you do not have the access to the real-time volatility calculation, which can be done with one software, if you do not have that access, the best process is you should calculate the volatility from the past 10 days data. That is first thing. Second, identify the uptrend or downtrend price point as per the Fibonacci. In case of there is a gap up or gap down, you have make some adjustments. Means you have to change the last price with the gap up price and gap down price. Then you have to enter at uptrend with hedging if you want. Enter at downtrend with an hedging if you want. So this is the process. These are only 4 processes. So here currently, if we just look into these values, so 31st March to 17th April, this comes to 10 trading days. Very carefully listen to this. Most of you have known this method. Many times I have taken it. However, the current situation warrants a different approach for this particular method. So now, just to delete these parts, and I have to take the logarithmic value, ln values of this thing, logarithmic of current value divided by the previous value. Then you have one ln square value. So this, and we need to take the square ln values. So ln square values, and once we have done it, so this entire thing we have to copy paste so that every row we have done that one. Then the average of this thing has to be taken, ln values and ln square values. Then the variance need to be calculated. So ln square values minus ln value whole square. So till this point, the calculation is perfect, and then we have to take the square root of that. So this will give us the daily volatility. Daily volatility. So once you get the daily volatility, so which is nothing but the square root of the variance. So first you have taken the ln values, second the ln square values, then we have ln values and ln square values. So here the average, so first average and second average, variance, so ln values minus ln square values, then square root of this part, if you take square root of variance, so this will give you the daily volatility. So once you get this daily volatility, now question comes, if it is in a feasible range, what is a feasible range? So 10 to 15%, 20%, not an issue. So you can able to trade on that. Certain data points, if I change it here, just have a look here. So here, if I just change certain data points, so certain data points, if I just change here, because there is a huge oscillations happened. You would have seen that. You would have seen that recently there is a huge oscillations happened, and this is all our. So this was our original value. I'll just keep this value. So this was the original value. I'm just taking the spot data here, and this value, if I change it here, have a look on this part. So, once till 17th April, if I take the same value, spot Nifty data, and you are getting the daily volatility comes around 3.5%, 3.5%. This is the daily volatility it gives. So if you look into this daily volatility of 3.5%, in price range terms, it comes to 329 price, 329 rupees. So here yearly volatility comes to 67%, quite high, above 20%. So here what you need to do, that is very important. So once such kind of volatility you are getting, preferably in the index, whenever you are getting a 25% above volatility or 20% above volatility, or any stock is giving you some 40% volatility or higher volatility, can we drop this method or we can do some realignment into that? So here, to make this method to work in the higher volatility band, what you need to do, whatever the daily volatility you have got, just divide it by 3. Why this division of 3 happens? Because your intraday having a 3 different cycle. Once your complete or volatility is too big and that comes to about 20%, so it is better that you should divide it by daily volatility, you should divide it by 3. So once you divide it by 3, your price range also changed, everything has changed, and which was originally 66%, it has come to 22.66 now. So then you need not have to tweak it again because it is 22.66. Don't think that it is 22, I have to again tweak it. No, not required. Even though if it is 80, you are dividing it by 3. So, or anything. So once you divide this daily volatility by 3, nothing else you have to do. Just you have to follow the price range, whatever is coming that. So daily volatility into reference price of your 17th April. So these are the levels you can get. So how you can get this thing? Price range multiplied with all Fibonacci ratio. So you will get, so 109 multiplied with 0.236. 109 again multiplied with 0.382. All price ranges you will get, add this price range to the last reference price, and you will get all these levels for your trade. So all these levels you can able to get for the trade. Even if it is 4, 40 or based on 3 cycles, you need not make had to have or 1/4 or 1/6 based on your convenience, because intraday is having a 3 and 5 cycles. So it doesn't have a 4 cycle, it doesn't have a 3.5 cycle, 2 cycle like that. Elliott wave for that reason only having a 3 and 5 waves. So this 3 and 5 is one of the standard protocol for the cycle theory. So here, whatever the, once you are seeing that yearly volatility is above 20%, so daily volatility divided by 3, so you have scaled down that volatility. Based on that, the price range also gets scaled down, and now Fibonacci ratio you multiply with the price range, add it from your reference price, subtract it from your reference price, and derive all those levels and follow it. So this is one of the changes if you brought into the system, then this system works wonderfully and you need not have to hunt for any other method for doing the intraday trade. So this is the Nifty future data I have taken now. So I have just taken the Nifty future data. You have seen this. This is the Nifty future close data, close prices. I have just taken it. The last traded prices, if you get, it will be better. So you can, I have just taken the Nifty future data. So now if I take the Nifty future data here, so here you can say that, so maybe some inconsistency is there. So let me have a look on this. So this is the data. So maybe some inconsistency is there. So I'll just copy it and paste it here. So Nifty future data. So now you don't have to, it is divided by 3. I need to remove this. So now based on the future data, I am getting the volatility as 12.55%. So nothing to change here. I can straight away use this thing. So let me see how it has performed today. It is for till 17th. So how it has performed today. So that that part you can so this is till 17th data. We have done analysis today. Market would have opened and it could have done something. So first I'm going to the NSE site. So what are the things happened today? So that is very important. So this is the calculation we have done. Today morning also we had a live session where I have demonstrated all our software. And Nifty also you got a success. Bank Nifty triggered the stop loss. Sun Pharma you got a success. So Tata Steel also has given a success. Many things you have experienced today. And I'm going for the index now. So here equity derivative Nifty. So Nifty I have to go for. So Nifty today opening price was 9332.05 and it's a flash high. So you can morning we have seen it and it has not that 9384.75. So we have never experienced or seen this part. So you can see that it has opened here 92 and or else I can go for this live analysis and chart part. So this will give a correct info, much clarity will come here. So for this, the chart to see, you need to first enable the flash. So first flash need to be enabled. Then you can able to see this price time chart of the from NSE, the most authentic source of our price time chart. So here Nifty, I am loading this data and I plot this data. So Nifty 1 minute and so better I can go with the 5-minute chart. So you can I can plot it here. So you have seen that this is the our calculation happened and I have to maximize it. The first candle itself it has 9384.75, 9292.55. So the morning high what you have been seeing, so that is not the high what we have or the high which has stand in the market. Or you can see for the 1 minute chart also you can just see experience these things when that highest price point happened. So you'll see that the first candle 9:15 candle only has given this. So within 1 minute to execute that trade is quite impossible. So that is a false high you have got in the very beginning period 9:15 period. So this part you can ignore it. So all our trades when we have to start, many of you are using this system. So when after doing all this calculation, what will be the best time to start this trades? 5 to 10 minute gap you have to give. So you have to start the trade by 9:25. 9:25. So 10-minute gap you can give. So then after 10 minutes, you can look into the price points. Where is your price? And based on that, you have to compare with your calculations. So if I just focus here, so if I focus here at 9:20, so here 9:25 time, if I focus here, what was my price at 9:25? That can give you a more clarity here. So here is my price 9:25. Closing prices of 9326, 9326 was the price. So this is my calculation which is ready in my hand. 9326 price point was there. 9326 price point. So 25.75 is 0.23 236 retrospect. If I can think, I can buy it here with a put option, and my stop loss for this same trade will be 9287.91, and once this 9287.91 comes true, then I have to trail my means I have to close my trade and enter to the short side of the trade. So most important part is these are the things you have calculated. So what happened during the day? So during the day, that is very important. Very important during the day. First candle you have seen, and then after also you have seen the movements in the chart. So during the day, you have triggered. During the day, you have triggered. So maybe it is for the newcomers, it will be a very astonishing fact. And during the day, it has gone to 9215, which is not a flash crash. It is not a flash price. This 9385 is a flash price. It has just come for a 1 minute, few seconds and gone. But 9215, the low, which is very much has come around 11:30 period. In the chart itself, you can see. Post this 925 period, post this 925 period, you have you have come to a level of here, so 37. So I can say that here also 35. So this is the highest point post 925 period, 9337. Here one part, 9335. So no point of time price has moved above 9335. However, the low what you have got, 9215, 9215. So if you compare with your targets here, so though first trade will be a failure trade, if you have gone with this calculation, you bought this here, and you can see that this is your calculation of 0.382 to 0.5. It is as per the yesterday's reference price. So the price has never crossed this level post 925. Past post 925, it has never crossed this level. However, the price has come to 9215 level, so which is just 3 points above your last target. Though the first trade would have been a failure trade if you would have bought it at 9326 with a stop loss of 9287. However, if you would have reversed the trade there, you would have got a fantastic target till 9235. So calculation wise and days high wise, days high you would have seen that 2 times it has tried to move beyond 9335, could not able to make it. However, it has days low 9215, which is a very much within your calculations, and high is also aligned with your calculation. So two things I have explained to you. Why you should, as an investor, why you should deploy a part of your capital in the mutual funds because of a good valuation, earning outlook is good, and once the stability comes, the large cap mutual funds will have a great move. Then I have taken to you how you can utilize the volatility calculated from the past 10 days data to do the intraday trade. Herein I have told, in case if from the past 10 days data reference, if you are getting the volatility above 20%, so the daily volatility you must divide it by 3, so that price range and other things will be automatically get aligned, and that aligned part will give you a good amount of success. So this is the two things I have told you. Now moving to my third part, wherein I'm just going to tell you about the pair trade in the Nifty and Bank Nifty, how you can do pair trade in Bank Nifty and Bank Nifty. And so pair trade in the Nifty and so the pair trade in the Nifty and Bank Nifty, how you can do this is also one of the new concept we have recently come across. So here I am using only one parameter called the Z score. So this Z score related things also I have told you. So those who are having our software, so we have also recently come with one software, our technical analysis and volatility scanner tool. So this is being given to all of our buyers at a free of cost. So those who are having our software, we have given them the freely, we have availed this software to them. So only the our active buyers. So now this particular software gives you the Z score calculation. However, I'll just explain how this process of Z score related pair trade works. So first, what you have to do here. So I'll just go back to this Excel presentation. What is a Z score? First, we have to understand what is a Z score. So Z score is just for those who are the non-mathematics students, those who have very feeble knowledge about the mathematics. So for them, those who are the brilliant mathematicians, those who know about great about mathematics, they may be knowing what is a Z score. So the Z score says that the standard deviations, how much you are away from the standard deviations, how much you are away from the standard deviations, and that too from a mean position. So you take for a very simple example you can take. So you can say that you are one step away from your house, or you are two steps away from your house. So this is how the Z score says that. So 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 that is how many steps you are departing or differentiating from your destination or mean position. That is what your Z score says that, and it is being drawn in a normal deviation uh, curve. So all of you will be knowing that there is a one standard deviation also derived from this bell-shaped curve. So it is a plus or minus one, means there is a 67% of math deviations from your mean, and there is a plus 2 or minus 2, means it is a you are having a 95% deviation from the mean. So just forget about this mathematics. This is not only for the definition sake. I have told you, this is not going to help you in your trade. For as a trader, you have to just remember, everything we compare here is the Nifty and Bank Nifty. So here, if the Z score is plus 2, we'll be buying Bank Nifty and selling Nifty. And if Z score is minus 2, we'll be buying Nifty and selling Bank Nifty. Plus 2, minus 2, this is the two numbers you remember. You can, if you go for a hedging also, you can enter plus 1, minus 1 also, nothing wrong in that. In the low volatility scenario, when your VIX, Nifty VIX is less than 30%, you can go with the plus 1, minus 1 also, nothing wrong in that. And if you are hedging with the option, you can still go with the plus 1 and minus 1, plus 1 and minus 1, in spite of a higher volatility condition. So now this Z score to calculate, there are different processes. So here first thing is that we have two different data points. One is Nifty and another is Bank Nifty. Pricing terms both are entirely different. So one is in the some 10,000, another will be in the 27,000. First we need to normalize this data. So first, with this two different data, we can't able to do the Z score analysis. So Nifty is a data and this is another data. So we need to calculate the normalization of the data. So we have to take so normalization involves lot of processes, many processes are there to normalize two different random series data in statistics. So this is one of the formula you can see, logarithmic value of the Nifty I am taking minus the Bank Nifty price divided by the Nifty price into logarithmic value of the Bank Nifty price. So this is one process of normalizing the data. So I want a common data from which I can calculate the Z score. So once this is known as a spread, you can say normalization data, anything you want to say. Why I am doing this thing? Z score only can be calculated from one data. We cannot take two different data series for calculating the Z score. So for that, normalization need to be done in the data. So normalization having multiple process. The software what we have developed, that is using somewhat the advanced process of normalization. So this is the very basic process of normalization. We want a single data and we have taken it, and after finding out that single data, we have to take the average of that. Once you have to take the average, then you have to take the standard deviations. How much standard deviations is there? So that is using your standard deviation functions in Excel, you can find out the standard deviation. So this is from the series of data. So first average you have taken, then standard deviation you have taken, then there is a formula for the Z score. So you are doing the actual data minus the average data divided by your standard deviation. So here the actual data, this is the actual data, this is the average data, this is the standard deviations. So actual data minus the average data divided by your standard deviation, this gives you the Z score. So this is the common formula for the Z score. Only catch area is here, the data normalization. So data normalization is very key to this particular method. So I have done the normalization in one process. You may be doing the normalization in other process. So that depend upon how you are taking that normalization. Normalization means both the data we are bringing into a single format, single data, because Z score we can't able to calculate with two different data series. Once we find it out, so we have to calculate this Z score. So it is from the past 10 days I have taken, from the past 10 days reference I have taken. So once this particular method is being done, so now there is a point in 28th January, it has gone to 2.5. So once it is plus 2, you have to buy Bank Nifty, sell Nifty. Then how many lots I should buy, how many lots I have to sell, so that depend upon the spread. So sorry, that depend upon the hedge ratio. So hedge ratio is nothing but you just divide the Bank Nifty divided by Nifty. So you'll know that how many lots of Nifty can be hedged with the Bank Nifty. That means if you go for 2 lots of Nifty and 3 lots of Bank Nifty, mostly the contract value will be same. So that is what the hedge means. 100%, how much I am buying, the same amount I am going to sell. So that is what the pair trade principle is. So 2.5 I have entered. I am buying Bank Nifty and this value you can see here. So once it has moved, so 26,653 I am buying the Bank Nifty, 3 lots. I am selling the Nifty 2 lots, 10,661, and that too also coming to 15 lakhs 99,000. Here too also 15 lakhs 99,000. Only the odd figure is last 3-digit number 183 and 230. And once this Z score, if I am going on checking, once the Z score changed from positive to negative, you can say I have entered at plus 2.5. Let it come to plus 1 level or very close near to the plus 1 level. So that point of time I am closing my trade here. So whatever the trade I have bought, I am closing it, and whatever the trade I have sold, that also I am closing. So here the profitability in the Nifty, Bank Nifty, and liability in the Nifty, but the net comes to 13,000 positive. Very next day again it goes to the 1.94 near to 2. So I am again entering, and here too also on 11th February it is giving you some 9,238 rupees profit. Same way it is again giving you on the 22nd February 13,000 profit. So this process, if you go on continuing multiple times in the entire, I have just taken from 2019 January till the time of 2020 April. So this, in very rarest cases, you can say in the more than 85% of cases, it has given you the profit. Into 10 to 15% cases, it has given you losses, and that losses also very feeble, very small losses. You can see here also. You can see here we have a plus 2 crossover, almost plus 2 crossover happened here, 3rd April. 3rd April. So here if I am buying 3 lots, so 3rd April price you can see. So this is a 3 lots I am buying, 3 into 20. This is the buying value, 10 lakhs and all. And 3rd April I am selling this Nifty also 2 lots. So 10 lakhs and 12 lakhs. So if this is the value, and currently if you can see that, currently whether I am in the profit or loss, so this part 3 into 20. So in fact I will tell you that what went wrong here. So for that reason only we can a little bit, if you would have realigned it, then it could have been a successful trade. However, so this is the value we got. If I can just look into here, so here my bank Nifty given me a profit of 2 lakhs and 6,000. Nifty has given me a loss here of 1,77,000. So here too, you can say there is a profitability of 28,000 has come from 3rd April to 17th April when it has come to the level of 1.87 plus 2 and 17th April you are entering here. So on 17th April this thing has happened. Then at this stage what need to be done? Can anyone will tell me? On 17th April, you are getting this Z score as minus 1.78, very close near to minus 2. What can be done at this point of time? What can be done at this point of time? Reverse. You can sell Bank Nifty and buy Nifty. But one thing very carefully you have to look into here. So the correlation parameter also you need to look into. Correlation above 60%, it is good. So Bank Nifty and Nifty maintains a good correlation. So at this point of time, if you want to enter on the 17th of April, you must buy Nifty and sell Bank Nifty. Sell Bank Nifty, and the contract values have now changed. So you have to recalculate the hedge ratios, and you need to do it in the different way. The same thing Nifty and Bank Nifty, the way we are doing this Z score. And this new tool, we have given a complete scanner. All Nifty stocks, we have given a complete scanner. So this can scan for all stocks and give the Z score. But this Z score, what you are getting as per the yesterday's closing data, as per the Friday's closing data, not for Monday's data. So to get the Monday's data, just you have to double click on this. So you will get the latest Z score what is associated, and it comes with the correlations parameters and all. It comes with its volatility. So it was 1.59. Currently, as per the current price, it is 0.56. So this tool also is a great tool which can help you to form the pair trade using the Z score with any stock, any Nifty stock. So any Nifty stock you can, Nifty future stock you can able to form the pair trade. But Nifty and Bank Nifty, it is giving a phenomenal success, excellent success it can give, and it's a past 1 year's data points it shows. So if based on this condition, if you would have traded in worst case also, it has given a great profitability. Only exceptional is the time when this VIX has moved above 60% during this fall. So that time it has just slipped for a couple of days, it has slipped into the loss side, but again it has recovered all those losses and come back to its origin. So you'll be at a loss if it moves above your 60% of correlation. So how to book the profit? Whenever it comes to the level of negative, if positive you enter, it goes to the negative correlation. Then only you have to book the profit. There is no stop loss here. There is nothing, no other methods to book the profitability. It means book the profit. So you need to wait for that particular Z score to come. Then only you can able to book the profit. But it is better whenever the VIX moves above 50%, better do not enter this. So 50% above the VIX moves, better do not enter this kind of trade. Even though if you enter, hedge it. Free programs, Excel's PPT, I never used to share. So recordings only you will get. Recordings will be you will get to view those things. But free programs having some limited scopes. So if I provide those documents, I should be in a position to clarify your doubts also. So it's a free program. free program, only limited scopes will be there. So none of these documents will be set. 7 o'clock it will be updated. So you will get the today's data. So tomorrow morning, once you open, you will get this data, which is history. So you just double click here on the symbol. So you will get the latest one. So current data it will fetch, it will calculate and pop up. So if you just double click in any of the symbol, so Tata Chemical or any of this symbol, if you just Bharati Airtel, if I am double clicking, so it will pull the data and it will calculate and tell you. So this is as per the yesterday's data, it is 1.6, now it is 1.39. Better to have a fair trade whenever we talk about 1.5 to 2% is a good zone. So Z score basically the very idea of initiating this, what is the very benefit of doing a fair trade? Can anyone will tell me? The benefit of doing the fair trade is to protect your capital from any huge up move or down move. If you do the with the pair trade along with some hedging, you can say that you can protect your capitals to the maximum and still you can make the money. So it is one of the best way to do the trades. So you can say something beyond intraday start thinking. So that is so already you will be having, if you are a paid member, Rauji, you message me, then you would have given, we have message to all of you if you have not got. So once you go for these things, this particular tool, and besides that also we have given some technical indicators along with this. So here you can see the technical parameters of these things. Many technical studies also are being programmed here. So some moving average oscillators and other things. So as per yesterday's data, what it was suggesting, as per current data, what it's suggesting, it is also being given here in this particular tool. The how with smart finance itself you can able to start your mutual fund investments. Online portal is there. We have dedicated desk, and so that is also depend upon your interest. You can do it. So so this is one part I have taken. I have taken how you can use the volatility technique in a different way to do the intraday trade. So tomorrow we will specifically discuss about the option trades, option intraday, positional, how we can utilize, what is the best option strategy we can take for the result season. And also I will take you to the Elliott wave principle, how you can invest using the Elliott wave principle. So that will be discussed tomorrow, 5 p.m. same time, 5 to 6 o'clock. And do not miss tomorrow's session. The recording of today's session will be given tomorrow morning. So tomorrow morning it will be given to you. So you can check our YouTube channel so that you will get that recordings. So with this, I will be ending today's session. Thank you very much.